Hey guys, it's John Kirby back with the Bear Trap podcast. My co-host is Vic. All chart credits go to Ock. We still have a lot of charts in this episode from Doc and all the services that he subscribes to because this is the second half of our interview. And here we go into some of our more, I would say, classic analysis of the markets, and we look into what I'd call the failure of the bears over the course of the last week, and then what that means for the future. Part of that is also going through some of Doc's trades from Friday, and then towards the end of the episode, we go back to a really sort of clear prognostication, which I very much appreciated. So yeah, thanks to Doc again for coming on. I hope you guys enjoy this one. Like, subscribe, share, etc. All right, I'll see you in the next one.
Well, what I was doing on Friday was, okay, let's look at that. So this is yet another visualization of the same options, open interest and gamma. And what spot gamma does is they kind of illustrate the convexity of the move. Like if you look at a risk graph or risk profile, it kind of shows you how things might move. However they do, whatever the secret sauce is, I've come to like it. And so if you look at number two, 4150 support, number one, which I labeled as number two. No, number two is the notch, okay? Number two is the 4110 notch. So I started the day off selling puts underneath that. Mm-hmm. I had total faith that was going to hold.
Sorry, we're talking about 4110. So it's this sort of...
Right. Cool. See the number two down there?
Yeah.
The notch.
Cool.
So if we tip over whatever like that little point was, which is probably 4050, we can quickly accelerate. The hedge would cause a quick acceleration down to there. That would pretty much hit a brick wall.
Brick wall at 4,000, you mean?
On the upper left.
At point number 3 would be a brick wall.
Yeah. Okay, that makes a lot more sense. I see. You're looking at this in a much more fine-grained. Gotcha.
Okay, so you see it says 2 is the notch with 3, which I didn't get labeled. Oh, there it is, 3.
Yeah, it's here.
But that 3 should actually refer to where the little hill is right above the notch.
Mm-hmm. Okay.
Okay, so with 3, which, let me see, can you see my cursor? With 3 being right there.
Okay, gotcha. Yeah, I think I get it.
I didn't do a great job getting the numbers where they're supposed to be.
Well, let's just talk about it as like hill number 1 or like peak number 1.
This is the hill over here that's defending this valley. So once we didn't break this hill here, I have 4075 as initial resistance, 4050 as initial support. Once we kind of stayed there, that's when I had confidence to stay in my longs. And, at some point they were down, at some point they were up. And so during the day, I referred back to this and said, okay, so what do I expect to happen? 4050 is holding, and it's whatever, noon, 1, 2 o'clock. Whatever gamma is down here is vaporizing. Those puts are decaying. Market maker is going to be buying back whatever shorts they hedged. VIX is coming down. We should, in theory, accelerate up to that line. And we did, give or take 4 points. And we stopped right at the mountain that's supposed to stop us.
Yep.
So I used that to set up my broken wing butterfly. I was long the 4065 when we were down at 4050, and I was short. I had a few different strikes in there. It was like it was an asymmetrical one. I was short like I was long like 4065, 4080, short 4090 or 95, 4110 times 3.
Okay.
Giving myself a big decay area up here that we're not going to go over this one. We're not going over there.
Yeah.
So I'm willing to sell that and have the longs pull me up here and, kind of, I was a 4065, 4080. We closed at 79. Now I'll admit I paper handed it and got out of that at 10, 11 points, I could have held on to it for 14 points.
Gotcha. I do have a question there because I mean this makes a lot of sense in terms of like I see how you're generating your positioning. Um, Although one issue that might be par for the course is that if all of a sudden because these walls are so strong, right? If all of a sudden we were to break, let's say 40-50 to the downside, that move is going to happen really quickly, right?
Yep.
So your response time has to be fast.
Has to be fast. Well, that's why you see there that 40-40 hill, that which is basically the 40-50 area, a couple points. So we went below 40-50 a few times. We didn't break 40-40. In theory, if this is correct, had we broke 40-40, we're at 40-10 before we could, you have to react real quick, get out or get in.
Mm-hmm. Gotcha.
And so what reminded me about this, we had it in the queue anyway, was that during the day, more than once, I checked back to this to see where my exact levels were and to remind myself what I told myself.
Yeah, because it's scary when you're in the moment, but you have to.
Exactly.
I do that all the time too, where I check in the middle of the day, even though I have the levels blazed into my head. I'll check back at the GEX charts and just be like, well, are we above it or below it? And they're like, oh, we're still above it. Okay, just calm down.
Right. Exactly.
Yeah, Vic, did I interrupt you there? Did you have a question?
No, no.
Okay, cool. Good.
No, I think I was saying something earlier, but I forgot what I was saying. So I was just listening to Doc.
Yeah, I'm learning a lot. Thank you, Doc.
Yeah, I am too.
And now looking at this chart, the picture's probably not going to change appreciably because I've noticed, Gamma Edge has noticed, other people have noticed. I think I might have mentioned it. I know I mentioned it briefly in some of my notes that there's correspondence or confluence, whatever you want to call it, across expirations. What I mean by that is the 4,000. There's open interest in the 4,000 for Monday, for Tuesday, for Friday, for next Friday. So that's going to those levels are going to stay. It's not like they're staggering them out that much lower or higher in different time frames. We just add strength to the level, makes it stickier and also more crucial if it breaks or holds.
Well, and I think that's something that we were looking at in our last podcast because we had I had titled it "The End Is Nigh" because we were talking about how we could get this waterfall sell off because of course like people were positioned in relatively equivalent ways across levels,
exactly.
Right? So you saw pretty even gamma, but now we've moved just like you're saying into a picture where all of a sudden actually we have these really major strikes at 4,000, 4,100, the century strikes you're calling them, which makes it really hard to get that sort of waterfall feedback loop effect.
All right, but now you see that cliff at 4,000.
Yeah, I do.
I mean, we break that 4,000, and it's pretty much a straight shoot down. So where's that notch? What is it? I'm gonna guess it's 3,900.
Probably 3,900. So this something Jim was talking about was
the valley, not the hill, the valley.
Doc, does Jim talk about this with you? And he was saying it on his interview about how a watched market never boils.
Right, exactly.
And I think everybody sees, you can just look at a chart and you could see that 4,000 breaks. It's going to be a nice move lower, but isn't it everybody's looking at it though, aren't they?
Exactly.
And that may be why this hill here at 4,000 looks the way it does. Because
bulls and bears are lined up with their bets, and exactly. Go ahead, finish your point.
Oh no, yeah, that's exactly what I was going to say. They're lined up, and it's just the battle zone, and really, I think the Bears are the ones that have, they've got to get the ball in their court because I think they're the ones with the timetable.
Exactly, they're the ones that are decaying.
Well, and Thursday and Friday were a big failure, right? Like that's
huge monster failure.
I mean, especially when we got that waterfall sell-off on Thursday. I mean, I think part of the issue was also timing, right? If we had been able to start get moving on VixX, which was Wednesday, and then continue
That
on
was a
Thursday,
fail too.
that was the failure. Yeah.
Huge
Yep,
fail on
yep, yep.
VixX.
And a lot of the action on Wednesday and on Thursday was that post VIX expiration repositioning. Now, I don't know. There's been a lot of anecdotal comments by those people that are in the weeds on the big VIX call buys out in I think it was May and June. Um, and how much of that's repositioning from what just expired, and how much of that is a new bet is a whole nother story.
Yeah.
Yeah,
No,
I look at that every day, and a lot of it is new bets now after that VixX, in my opinion.
I agree, because it's not as if, right? I was looking at March 22nd, the March 22nd AM expiry on the VIX, and they don't have as many of those crazy calls on there.
No, I think this is going back into what Jim is talking about again, is folks are not going to be trying to get long vol like they used to.
Right. That trade is dead.
They think it's dead, and that's usually when it happens. So I'm starting to look out into the end of March as being what we thought February would be. The quarterly.
Yeah, if they don't get positioned for March, I think maybe, yeah,
That's why
that's an idea.
So the big trade was a big June trade on Thursday, I think it was. The trader that's known as 50 Cent, because he buys 50 Cent strike VIX calls, that he pays 50 cents for them. I forget what he bought. He bought them on Thursday in the morning for 50 cents, and they were $1.50 on Friday when like VIX peaked. I don't know what they are now. They're probably back down to 50 cents.
Yeah, I think everybody was watching the February OpEx, and I think that nobody's going to be watching the. This is just my theory for now, but nobody's going to be watching the quarterly OpEx like they were. I think they're gonna forget about the long vol trade. It may hedge somewhere else, but I don't think it's going to be in the VIX, and I don't think it's going to be as heavy in SPX.
Well, we can get into that in some of the next couple of charts that we have and see how the positioning is. Then the other thing to mention before we move on might be that the 40/50, however you pronounce his name, like the Icon puts or whatever, the ES
Icon,
puts.
yeah, Carl Icon, yeah. He's in the 3950 ES, 4050 ES.
Yeah, exactly. 40/50.
He had the 40/50 for Friday, and on Thursday he had a triple. I would have gotten out.
Did he not? He didn't get out on Thursday?
Crap, I don't know.
Oh God.
Yeah, I'm not sure if he got in or out, but it's hard to know, because do you see that reflected in the SPX gamma charts and open interest in buying it on ES?
No, you're not going to see it on the ES, but the market makers still have to hedge. You're not going to see it on the SPX gamma, but the market makers still have to hedge for that.
Yeah, they have to hedge, and you can see it. Like I was watching the volume and open interest like on ES itself.
That was another thing that tipped the scale that day, bringing us down. When those came in at 11 o'clock and 1 o'clock, there was two tranches, if my memory serves me well. That also tipped the scale, bringing us down to the next inflection point.
Yeah, but then I think also that was one of the reasons that I don't necessarily, because I remember I did the math back when he bought them, and when he bought them, it was originally the equivalent of like I think it was like like 12, maybe 15% of like overall. Like let's say that the largest strike had like 200 million in gamma for that day. The puts that he bought had like, I don't know, they would have had like 25 or something like that.
So it was a really large factor of whatever else was going on.
Yeah, it turned into a larger and larger factor. But I think part of the reason for that was probably the reflexivity. I think other people were looking at it and they started hopping on, not necessarily the intrinsic value of the, or sorry, I shouldn't say intrinsic, but not necessarily the value of the original bet.
Okay, let's see. Well, where are we now? We've kind of meandered a little bit.
Yeah. Well, let me go back to the charts and see what I have next. Because we have oh, I guess this was SPX from. Oh yeah, this is a longer timescale chart.
Yeah. So this is kind of one of the things that one of my kind of default charts that I look at, and this is kind of going back to TA 101. Basic TA, look left. I have a band on there. The only reason, so just to orient people who are looking um, at how I have it laid out. And here I follow the same layout that Greg uses on Master Trader. Master Trader has a live a live broadcast every morning at 9 o'clock on YouTube and Facebook and maybe Twitter, wherever they have them. And I jump in on that. I guess I consider Greg and Dan to an extent my my most recent TA mentors, which actually had me get all the DMIs and RSIs and Williams percent R's and all that crap off my charts and just basically make my charts a lot more simple. Um, and so this is the layout that he uses. If anyone is listening, they want to chime into that. I'm on that. I chime in there sometimes in the morning. You'll hear him. You'll hear Greg talk about selling put spreads, SPX put spreads, and I'm McGraw, same screen name here as there, and he'll say, "Oh, McGraw says" or whatever because it's a type chat.
Oh, gotcha. Yeah.
So, but anyway, so the orientation is the same one that he uses. That was kind of that tangent rabbit hole. And on the upper right is the daily. Upper left is a 65-minute.
Gotcha. Yeah.
And the reason it's 65-minute, not 60, is because there's 65 minutes in a day. So each bar represents an equal amount of time.
Mm-hmm.
And then on the bottom, to the extreme left, I have a weekly for context. I have a 15-minute, which is my default time frame on another screen that I keep up. 15 minutes basically, for me, the most comfortable one to trade for my style, basically 0 DTE and looking out a day or two or back a day or two. And the 5-minute to tweak entries all the way to the right.
Gotcha. Yeah. Yeah, I don't know. I like the look of these charts. It's very like peaceful in a way.
Now, getting back to what I was going to say about the upper right chart, I have Bollinger Bands on there, which I normally don't put on there. The reason I put them on there was my last call with Gem in December. It wasn't the January call, it was the December call, I believe. He said he expected us to kind of ride or trend toward the upper Bollinger Band through January. And look what we did.
We most definitely did that. Yeah.
And that was based on the options position. He didn't do that based on technicals, whatever. I mean, he knew enough to say it's a Bollinger Band, but it was basically however he, in his secret sauce.
Well, I think I can tell you, Doc, actually.
Go ahead, I'm listening.
So I was looking at some other tweets that he was that he had made, and it's so the Bollinger Bands, right? It's a statistical measure. They're based on it's like a rolling moving average along with like a rolling standard deviation,
exactly.
Right? And so the first Bollinger Band is essentially I mean, I assume if you use the default here, it's probably 1 sigma, so 1 standard deviation.
Right.
And because everybody uses the same Excel formulas and the same Excel spreadsheets and everything, I would guess that in terms of hedging options, the 1 sigma is actually a relevant measure. In other words,
right, the 1 sigma, right, whatever the 33 delta or the 16 delta, that's what people are looking at.
Exactly. So if we were to break, so like on that day, right, where we broke through for a second and then came right back down, it's because if we had broken through, then this would have probably been a massive squeeze, I'd assume.
Right, that would have been a squeeze, exactly.
So we're using them for like almost the opposite reason of like what people might normally use Bollinger Bands for. I mean, obviously, like it's the theory is that price has to be contained within the zone, but the theory is also that the further it is outside of the zone, it's not going to revert. It's actually going to expand, I think.
Right. If you're right, that if it stays there, then we get the whole reflexive hedging to the upside instead of the downside.
Yeah, exactly. That's what I would assume. So if he says Bollinger Band, I'd assume that that's why. Just because
That
I
makes
saw some,
sense. Yeah,
yeah.
that makes sense.
So that's really cool, and I mean, I guess we can see here that basically this would tell us we have room to tread lower to around 4,000 without instigating a massive break to the downside, which from an options perspective makes sense,
Right.
right?
And of course, notice that where the Bollinger Bands, 4,000 and 4,200, basically where the options are.
Yep. Yeah. Okay. Really cool. Um, and then I guess I'll move to the next one.
What we
Yeah.
got next? Let's just see what we got. Okay. Um, so again, on my, I have a 6 panel up, and those are two of the panels on my 6 panels. That's to my immediate left. That's where my eye is, basically back and forth all day. And this is just what I keep up. People at home, can do what they, do what they want. That a lot of this is what my eye is comfortable with over the years of looking at the same thing. So it begins to tell a story without me having to think about it. But
Yeah.
what I wanted to point out is, so I have Vixen and the advanced decline line. You can also use the ADSPD, the S&P 500 advanced decline line, but I'm just used to the ADD for the whole market. But I want to point out what's been happening, and I mentioned this earlier about when we were talking about the initial hedging response.
Mm-hmm.
Okay, so you see it's broken into days. So if we look over here, that was Thursday. Drop, big hedging response. Dealers started to on dollar ADD on the bottom.
Oh, gotcha. Yeah. I see. Drop is
Okay, so on the open,
Thursday, right here
dealers
on the
had
open. Yeah.
sold, and they were down to the minus 1,500 level. Then it started reversing up throughout the day.
Mm-hmm.
Market makers, they did their selling, and then they had to kind of hedge up. We actually went positive on that day. Look at Friday, the last segment. We
Yeah.
opened down, big down, 2,000. Now, standard theory, the way it used to be, and I think I might have put something in here about this in the Discord a month or two ago, minus 2,000 open on ADD is sell calls and don't even think about it. And actually, if you had, we closed at 40.90, whatever it was the day before. Well, where did we close? Yeah, like 40.90. You would have been okay. You might have been sweating.
Yeah.
Uh, but when you get divergence between the dollar ADD, the advanced decline line, and price like that, that's powerful.
Hmm.
That's powerful. That pretty much tells you that the bottom is in. And we've been getting that. And if I had scrolled back a few days when we opened green and turned to red, the exact opposite happened.
Yeah, I see what you're talking about, right? Because the initial response on Friday in terms of the pure just SPX price action, it was an open at, around 40.70 something, 40.73, and then we actually came down to 40.51 in the first, I'd say 20-25 minutes. And yet, if you look at ADD, it's not going down any further. And then as price I mean, I should probably just pull up
Like
a
price
number of price
bottomed
chart.
out
It's right
at
here.
around.
Yeah, there we go. We came down until 10 a.m. and then we actually bounced a little bit and then we were just still down there all day, even though the ADD was going crazy.
945 was almost the exact bottom candle.
Gotcha.
And those are 15-minute charts.
Huh.
That's a 15-minute bar. So like the third bar, you see the first green bar on that one?
Yeah.
That's where we bottomed.
Yeah, that makes perfect sense. Yep.
And that's why when we wiggled below it a few times during the day, I didn't really get that nervous. I wasn't thrilled about it, but I didn't get that nervous, you know. So again, I kind of put a zoomed out display just so people can get a feel for what's going on. But I was watching on Friday. Oh, the 2 year dropped, and they started buying it. They started buying the 2 year bond. That confirms to me what I'm seeing on the 10 year. Okay, that the big rate scare is over. The big dollar pop is going to come down. And so again, I'm okay with my short put credit spreads, no time to panic. Okay, let's get out of my long puts. If we can get out with a small win, which I got lucky, because I got out of a small loss. It was kind of a trade where I've been, and you'll see I'll mention I put this on for science. Um, I've been putting them on small broken wing butterflies and asymmetrical condor kind of structures to try to like play not the pin. It's real hard to get the exact pin, but to get the zone.
Yeah.
And my gamma is telling me that the 40-50 zone is going to be important. It was telling me on Friday, and the 40-75 zone. So I want to have something that gives me a long, getting convexity up toward it, and that gives me short, getting convexity the other way. So where we opened, like the 65-50 were the two longs I picked on the long put and the long short, and then kind of broke the wings on the butterflies and on the condors in relation to that.
Yeah, that makes sense that you have it like a little bit more of a you have a little bit more of a buffer on one side, and then you have more as it ramps into your target, right? You're collecting more. Um,
And I know that they're not going to both be winners at the end of the day, because we're going to, now they could be losers. We could just expire in the middle. I have to manage them, or just kind of say, okay, I'm, risking X dollars, and, I'll get out basically losing the money, or, at some point, if it looks like they're wrong, I'll get out. But when I'm right, those usually cost me about, 250, $250, and they're a triple or quadruple. So I
yep.
don't have to be right that often. And I
Yeah.
can usually get out at a smallish loss or smallish win, if not. So, and often the way the market's been trading kind of up and down, like on Friday, as an example, I got lucky. I'm not that I'm such a genius. On Friday, once it looked like the 40-50 was probably going to hold, and that 40-50 butterfly was kind of green, a little red, kind of green, whatever, and whatever time it was, around 11ish or so. Last leg down, I said, you know what? Time to exit this thing. I'm still a little green.
Hmm.
Got out. Small win, not even worth talking about. Maybe made $50. Nothing. At least I didn't lose. And then I held on onto the longs.
Yeah. No, that was a beautiful play. I was watching it too, and it's one of those, like, I feel like there were a lot of moments on Friday where those divergences were just they just kind of stood out. It was kind of hard to believe, but they just stood out,
Yeah.
right?
Yeah, some days like the gamma plays out like as scripted. Not always, but Friday played out as like a teaching moment for gamma.
Yeah, the moments that give you faith on the rest of the days.
Exactly.
Just to wrap up, I was wondering about, like, um, if we were going to make any sort of projections, or maybe not, like.
Oh, your projections, good. Okay.
Yeah, I mean, we usually like to see if we, because it feels like we're almost doing detective work, right? Like sorting through all of this data and
That's
seeing if
right.
it,
Good way to put it.
does it give us any sort of indication about where the risk is? I think earlier you said, there's that upside squeeze risk. Um, I don't know.
Okay, so here's the way it looks, and this is not just me. This is Gem. This is Spot Gamma. This is probably Mike Wilson. I don't know. But from an options point of view, After a big monthly OpEx is a window of weakness or a window of non-support. We don't have especially that big February, those cushions, those bumpers, where we know exactly where things are. Now we know where they still are, it's still the same numbers, but they're further away in time, so the hedging impact is less, and what is closer in time is smaller volume, so those levels are not going to be as strong. So that said, we could bounce around even even more than we have been pinball style action, where like technicians are scratching their head and lines aren't working. Um, and the big thing to watch is that 4,000.
Yeah.
If 4,000 breaks and gets recaptured by February 28th, the big monthly OpEx, it's relatively big. And this is, Jem's thing, and I see it the same way, and so does Paul Duncan over at Gamma Edge, and a lot of people kind of see it this way. If we can kind of stay over 4,000 or be over 4,000 February 27th, 28th, 1st of March, the structure in March is such that it's a rinse repeat of the January, February rallies.
Yeah, that makes a lot of sense. The idea is kind of like if bears don't take advantage of the next week or so, a week and a couple days,
Yeah, a
right?
week and a couple days, yeah.
Then they're gonna have a really hard time.
We'll give
Um,
them to next Monday or Tuesday.
yeah, I mean it's a little bit right. Like I would assume that like normally I'd give them 2 weeks. Why are we only giving them one and a week and 2 days this time?
Because February 28th.
Ah, okay. Gotcha. Just because February is kind of a short month and the OpEx is, yeah,
Right,
that makes
right.
perfect
February
sense.
28th, OpEx is a little closer than normal, so it kind of squeezes the time frame in a little bit. We have this one extra day off this month, this Monday, so it's just a little bit more, charm, a little bit more decay floating in there. Now I know in theory, yes, the market makers price that in there, whatever, but the extra day off does add to the decay, especially for the stuff that's a little further out in time that's going to be decaying.
Yeah. Or I mean, maybe another way that we could put it is it kind of like it warps the windows a little bit, right? It
Okay,
kind
there
of,
you go. Whoops, the windows. I like that.
yeah. I mean, I feel like there's no, like language doesn't do this stuff justice most of the time. But yeah. Um, Yeah, that makes a lot of sense to me, and I think just based on the type of like if I'm looking at laddering to the downside, right? It doesn't seem like that 4,000 is really big to the point where right we could even get under the 40-50 and it wouldn't necessarily be enough to get us through.
Right,
Um,
right. So I mean, we could easily bounce around in those zones down there.
hmm Yeah, like those pockets that you described, right? We get
Yeah,
under
yeah, and then
here, all
look,
of a
and
sudden
those
we're
I always look for those pockets. And sometimes in my morning notes, I'll put little lines of circles at those pockets as likely parking spaces. If anyone watches Gamma Edges videos in the morning, if you don't, I suggest you hop on and watch them. They're on YouTube, Gamma Edge. I think he has them on Twitter now. Also, they usually hit the airwaves at around 9:15. I subscribe to his service, so I see the PDFs before they hit the airwaves. So that way, I usually don't have time to watch them. Then I'm usually doing 16 things at once by then. But if I have time, I will jump on and watch it. Um, but I suggest people watch that as well. Even watch it post hoc after the day is over, or midday with your like midday soup to kind of get a feel for what was going on in Gamma Land, and he does a good job of going through the AM and the PM explorations, what's in the big picture, what's in the 0 DTE, 1 DTE next week, and then kind of zooms back out to the big picture of where things are, and that kind of helps frame things. You know, it was, there's a saying about midgets seeing for miles on the shoulders of giants, So it's on the shoulders of these guys that I've learned that now I can kind of, pretty much see it myself, and so that's just kind of helped. That I still check with all that what they say. Usually there's agreement between most of the services, and what I think, what they think. Every once in a while there's like a nuanced difference in how what one might expect the market makers to do or the market participants in general to do. And that, sometimes I'll say, nah, I think that they're wrong. Sometimes I'll say, nah, I think that I'm wrong. You know what? I didn't look at it that way. You know?
Yeah. No, and I think until we get like the general prognostication makes a lot of sense, and then until we get to that expiry, it's probably just kind of a day by day thing, right?
And there's enough to evaporate in March. And let me just, one more number that's important to watch is 4065. That's the short call strike of the JPM collar, March 31st, roughly 40,000, 44,000 contracts. Even though it's that far out in time, it's enough contracts to show up and matter. Some services will show them as long calls, as if they were long, but they're not. They're short calls. So you have to kind of mentally flip there and think of them as puts there.
Yeah, I remember the last time we had all this nonsense. So it's like puts there basically if we're under 4065, pushes us down. Above they decay, pushes us up.
Right.
So maybe
That's why once again, one of the tipping points on Friday was 4065. That's also where I bought my long calls.
yeah.
Wasn't by mistake, I mean, it was that I had that as just another number in my brain.
Oof, well, I don't know. That it starts to get a little more dicey now. If I start to think about combining the 4050s and the 4065s and then comparing that to how much is that 4,000, it starts to get a little more dicey, I think.
Yeah, it's a little more dicey, yeah.